Hey, I'm Jason. This is Supply Demand Daily. I keep tabs on the economy so you don't have to. How you doing? Hope you're having a wonderful Wednesday, June 15th, 2022. It was a Federal Reserve policy meeting day. That means that the Federal Open Market Committee, which is the group of people in the Federal Reserve who are responsible for making monetary policy for the United States economy, well, they have been meeting or had been meeting for the last couple days, and today they came out with their much anticipated interest rate announcement, or their policy announcement, which is when they tell everybody in the economy, hey, this is what we're going to be doing between now and our next meeting, which is in July. So we're going to talk all about that and why they decided to do what they did. And we're going to go over the New York Fed Manufacturing Index, which is called the Empire State Manufacturing Index. We're going to talk about what the situation looks like for manufacturing firms in New York. And we're going to look at home builders and retail sales, which went down in the month of May. So we're going to talk about that. And in order to do that, I'm going to go ahead and get out of the way. And we have a lot to go over. So let's go ahead and get started. So first thing, what did the Federal Reserve do? They have a short-term overnight rate, which is called the federal funds rate. This is the rate at which banks can, and I'm talking specifically here about a specific kind of bank called a commercial bank. This is the rate at which commercial banks can lend their reserves to and from each other. Now, reserves are just the dollars that are in the bank's bank accounts with the Federal Reserve. So if you think about the way that you have a bank account at your bank, well, your bank, chances are, if it's a commercial bank, has a reserve account at the Federal Reserve itself. And so if it has too many reserves that it would like to lend out and make a little bit of money on those reserves, then it can lend it out to another bank that maybe doesn't have as many reserves. Now, this doesn't happen as often as it used to because the Federal Reserve has flooded the interbank market with bank reserves. So most banks have more reserves than they could ever possibly need. So there's a lot less bank reserve lending that goes on now, but this is the original design of that market. And what the Federal Reserve does is they used to they target a rate for that specific rate of lending, for that federal funds rate, and that's what it's called. It's called Fed funds for short. And so what do they do? Well, their previous target was a 0.25% target, so between 0.75% and 1%. That's what we were sitting at up until this meeting, and they upped it by quite a lot. They kind of, I don't want to say shocked the markets, because a lot of people, as we will discuss, a lot of people were expecting them to do this, especially in the last 3 to 4 business days, but they kind of shocked the system a little bit with a 75 basis point. Another way of saying that is a 0.75% hike in the federal funds rate target. So what that means is that the Federal Reserve is going to seek a federal funds rate between 1.5% and 1.75%. Now, the last time that they hiked rates this much was 1994, and so this is at least intended to send a clear message to the stock market and to the credit markets, which is another way of saying the market for dollars, the market for loans. This is intended to send a broad signal to those sorts of financial markets that the Federal Reserve is going to do whatever it can in order to tame inflation, and they will essentially stop at nothing. Now, the other piece of Federal Reserve policy right now is that they have started to reduce the size of the balance sheet. That is to say, they're going to reduce the amount of different kinds of bonds that they currently hold. These are bonds that they use to do what I said about 45 seconds to 60 seconds earlier, which is flood the market to reserves. And with reserves, in order to do that, they have to buy bonds. They have to buy different kinds of financial securities. And so they have a lot of those sitting in their portfolio, in their investment portfolio, and they're going to start to roll that off. They're never going to actually, well, I guess in theory they could sell those assets, but they're probably not going to. What they did in 2017 and what they're going to do now in 2022 is simply allow those things to roll off of their balance sheet. So these types of financial securities, they have a maturity date of any type of financial bond, any type of financial security that is not a stock. So any kind of debt security, well, that is essentially a loan, and loans eventually end. They come to mature, they reach their termination date in the same way that your auto loan does, the same way that if you have a mortgage, it eventually will. And so these bonds will roll off of the balance sheet that way. Let's say that they bought a 2-year government bond in July of 2020. Well, next month, they're going to allow that to roll off of the balance sheet. Now, some of those assets, they're simply going to roll over. So there are going to be some bonds that come up for maturity, some government securities that come up and mature. Like, let's say that one that will mature in July 2022, and they will simply buy another one in the same amount directly from, well, sort of directly from the government, but through an intermediary that's called a primary dealer. We don't have to get into that today. But the key message that they did, the key feature of what they did today was to raise that federal funds rate by 75 basis points. Again, another way of saying that is 0.75%. This was a surprise to me because if you watched my video yesterday, I said that they were going to hike rates by 0.25%, or otherwise known as 25 basis points or 0.25%. And I'm going to go ahead and stick with basis point language. Maybe 0.25% language will be good, but maybe I'll just bounce back and forth between those two because I don't want to call it too many things. But what was really interesting about how this whole thing happened is that there are a lot of ways that you can sort of watch and anticipate what the Federal Reserve is going to do. And what I'm showing you here is one of them, which is the Chicago Mercantile Exchange's Federal Reserve Watch tool. And the way that this works is there are certain futures markets, like I talked about yesterday, that are directly tied to the outcome of the federal funds rate. And so they will sort of extract from that data, extract from the prices of those futures contracts. They will extract a probability distribution of what the market seems to believe the Fed is actually going to do at their next meeting. And you don't really have to understand all that. What I'm really getting at is that as of about Friday of last week, the CME Fed Watch tool started to have a really high probability. So it started to place a very high probability away from a 50 basis point rate hike to a 75 basis point rate hike. If you can see this, what you're seeing on the bottom axis here is the rate that they would target in terms of basis points. So 125 to 150 means 1.25 to 1.5%, and 150 to 175 means 1.5 to 1.75%. And on Friday, when we got this really big print in the consumer price index, this really high inflation rate for May, basically everybody in the stock and bond markets started to become convinced that the Federal Reserve was going to do 75 basis points instead of what they were saying they would do earlier, which was 25 to 50. And there was even, I believe, an interview a couple weeks ago. It may have been longer than that ago, but this definitely happened between the last meeting and today's meeting. But Federal Reserve Chairman Jerome Powell said, and I mean he really said, that they probably were not going to do a 75 basis point hike. But then after we got this really big inflation print, everything just sort of changed. So there were many articles in the Financial this morning that basically talked about a 75 basis point rate hike as though it had already happened, kind of talking about it as a foregone conclusion. So I found that to be really interesting because the evidence that I shared yesterday, the reason that I was thinking that it was going to be 25 basis points is essentially this dark blue line at the bottom of the graph here. So what this is that federal funds futures contract that I was talking about, about a minute or so ago. This is a contract that allows you to take a position in what the federal funds rate is going to be X number of months from now. And this is the one that expires in the end of June 2022, which is in about 15 days. So essentially what this does is if you know that you're going to need to borrow money in, maybe the beginning of July or the end of June, and so you know that you're going to need to borrow money in the future, and you probably know how much, but you don't know what the rate is going to be, well, then you can take a position in one of these contracts, and that will allow you to make money off of an increase in the federal funds rate itself. And so this market is thought to give an indicator of an expectation of what the federal funds rate is actually going to be at the end of whatever month this is. So this blue line is June, which would tell you a rough guesstimate, maybe a rough expectation of what the market is, let's say an estimate of what the market is expecting the federal funds rate to be at the end of June when the contract expires. Now, yesterday, when I looked at it, it was 1.18, which would imply that the Federal Reserve's policy rate would be in a range of 1% to 1.25%, and that would be a 25 basis point increase from what it is now, which is the orange line. So right now it's in a range of 0.75% to 1%. That's why it's 0.83. It's kind of in between those two numbers. And so I was very surprised to see, stuff like this going all the way back to the day before the FOMC policy meeting, where we have a probability of 99% saying that it's going to be 75 basis points. Very surprising. And that is what the Federal Reserve actually ended up doing. So this is a little bit weird because the other thing about this is that if you go back and read Federal Reserve meeting transcripts, which are not released until about 5 years after the meeting actually happens, so that nobody really has any information above everybody else. But the other kind of crappy thing about that is by the time the Federal Reserve's transcripts, which is what they actually say in the meetings, by the time that comes out, nobody really remembers or cares about the current events surrounding that day, right? So it's kind of hard to, you don't actually know what they're thinking, you only know what they're saying. Even though, you would think that that's public information. There are certainly a lot of readouts of other types of calls within government that are made public or can be made public before that sort of time frame. But for the Federal Reserve, you have to wait 5 years. So in truth, that kind of sucks because the most recent Federal Reserve meeting transcript that you can look at in 2022, sitting this year, that would be 5 years ago. It would be 2017. So anyway, I found that to be really surprising, but here we are. We had a 75 basis point hike. Why does the Fed hike rates? Why are they doing it now? Well, the Federal Reserve's policy rate, which I have in the blue line here, and this is about 5 years of data, that kind of sets the benchmark for all other different kinds of interest rates in the economy, especially on a short-term basis. So the orange line that I'm showing here is the interest rate that's paid on 90-day commercial paper, which is essentially a short-term loan that is issued by both non-financial and financial companies in order to fund their short-term operations. And the reason that they do that is because they don't have uniform, perfectly matching cash flows. So if I need to pay my employees in, let's say I have to pay my employees every couple of weeks, but my revenue stream, even though I'm going to be good for it, even though if you total up all of the money that I'm going to pay out over the course of a year, even though the amount of money that I'm going to receive over the course of a year is well above that, even though I'm projected to make a profit, my flows may not all line up. So I may need to borrow some money so that I can pay my employees every couple of weeks. And so that I'm able to make payroll and essentially continue my operations and stuff like that, because maybe my revenue streams only come in once a month, or maybe I have uneven revenue streams to where I receive a lot of revenue in the holiday time. Maybe I'm a retailer, so maybe I make most of my money around the holiday time, and the rest of the time I'm sort of breaking even. So, maybe there's a need for me to borrow cash on a 90-day basis. That's just one business case of why, any typical non-financial company might want to borrow some money in the commercial paper market. And then, so the way it works is that the federal funds rate kind of sets a benchmark, like I said, for what those kinds of rates are going to be. And you can see that they have a very close relationship here, going back through a 5-year history, but you can look all the way back to, I think this series goes all the way back to the 1970s, and see that they're pretty closely tied to one another. Now, what's going on here in the earlier part of this year and the later part of 2021, you notice that the commercial paper rate starts to jump before the federal funds rate, right? What is going on there? Well, this relates to something that former Fed Chairman Ben Bernanke, PhD, said in a presentation that he made at a think tank in Washington a couple weeks ago. But he says monetary policy is 98% talk and 2% action. What does that mean? It means that in order for the Federal Reserve to raise rates, the Federal Reserve really only has one rate. They have the federal funds rate, right? They have a couple other rates that apply to banks here on the side as well. And they actually have more rates now than they ever have before, but those aren't really the super economically consequential rates. When they say raise rates, the Fed can do that just by telling people, just by telling the media that it plans to raise the federal funds rate in the future. And then what happens is that the market essentially has to, this short-term debt market, in the case of commercial paper, well, they have to respond to it. They have to adjust for it. And so the lenders in the commercial paper market, which means those people who are buying commercial paper, they will start demanding higher rates for their dollars. And so the average rate on commercial paper, which again is this orange line, will start to go up, months in advance of when the Federal Reserve actually hikes its policy interest rate. And so that's what it means when the Fed, if you ever hear somebody say that the Fed can talk up rates, or that monetary policy is 98% talk, the way that Ben Bernanke says that it is, right? That's kind of what that means. It means that they can move the needle with, it means that they can, thanks, John. It means that they can move the needle without actually doing anything, without actually yanking on a lever. They could just, they could talk something up like that, talk up a market. And I'm going to, probably just do that on a different day. Let's move on to the New York Fed Manufacturing Survey. This is a chart that goes all the way back to when the index first began in July 2001. And what do we have here? So we were sitting at a level of, I think I have the exact numbers. So we were sitting at a level of 11.6 to the negative side, 11.6 in May. And remember, with these manufacturers' indices, with these different business indicators, there's usually a level that below which signifies that the majority of businesses are undergoing contraction, that their business operations are getting worse or shrinking. And for a lot of the PMIs that I talk about on this show, the purchasing managers' indices, that would be 50. And for this particular one, this would be 0. So for the New York Fed's manufacturing survey, that level would be 0. We're sitting at a contractionary level of negative 11.6. That means 11.6, the share of manufacturers reporting that their general business conditions were worsening was higher than the share reporting that their general business conditions were getting better by about 11.6. It was 11.6% higher. And then we actually went up a little bit to negative 1.2, and it's still well within contraction territory. And when you start to see, a lot of friction like this particular chart goes back to 2017. When you start to see this friction, it basically means that, these manufacturers are in contraction, their business conditions are shrinking essentially, and that's what is going on. The orange line is their expected level of business, well, not expected level, but the percent reporting that their level of business conditions is going to be better in 6 months down the road than it is right now. So that's what the orange line would be. And maybe it's a little bit easier to see that in the long run chart. But you see that on these surveys, people tend to be pretty optimistic. That's why the orange line is usually higher, considerably higher than than this blue line here, or than the turquoise line. And they very seldom will intersect with each other, like in the literally the fall, but not really the fall, the spring of 2020. The only thing that was falling was this particular index off of a cliff. All right, so that is the condition of New York manufacturers. Another interesting thing that I pulled out of that survey is that the share of respondents who are reporting that the share of respondents who are reporting that their prices paid, that is the prices that they're paying for their inputs to the stuff that they use to make more stuff, the prices that they are paying for their inputs is going up. And that increased a little bit to something like 78%, I think it was. 78%. And then the share reporting that their prices received, so these are the prices that they're charging their downstream customers, has actually been going down for the last few months. It's still at a highly elevated level, but it has been going down for the last few months. Before we got this really big inflationary spike, this level of purchasing managers, manufacturers reporting that their prices paid were going up. So these are the input costs that they have to pay in order to manufacture their goods. It actually started to increase in the latter part of 2020, which was a good 6 months before we started getting higher readings in the consumer price index, which is, effectively the main measure of inflation for pretty much, media and economists and forecasters and all that kind of thing. So in this particular case, this indicator actually saw the inflation coming ahead of time. And one thing that I'm watching to see is which one of these will lead the other. So will we see a drop in prices received first, which seems to be happening right now, or will we see a drop in prices paid first? Well, the producers need to see a decrease in prices paid in order to start to drop prices received. It'll be interesting to find out. But producer prices have definitely risen faster, just based on the data coming out of the Bureau of Labor Statistics. Producer prices have definitely risen faster in the last year than have consumer prices. And they've been facing this for longer, right? This started all the way back in the latter half of 2020, whereas consumer prices only started really going up in the middle of 2021. So, Home Builder Index, it went down, but not quite as much as it did in between April to May, right? So it was a 10% drop from April to May, a 10% drop down to an index level of 69. And from May to June, it only went down 3%, down to 67. But if you, one thing that you'll notice if you look at the chart is that even though that drop was quite a bit less, it still looks like a straight line, straight on down. So, and it's looking a lot like this year here, which is 2005. All right. So, the industry is definitely entering a bit of a contractionary phase after a time of record growth. You'll notice that these levels that we saw over 2020 and 2021 are record-breakingly higher than they ever were before. If you average them together, they're going to sit a lot higher than the previous 30 plus years that this index has been in operation. But this Home Builder Index is based on two factors basically, which are sales, the number of recorded sales, and the traffic of prospective buyers, which another way of saying that also could be mortgage applications and people who are expressing interest in buying companies directly from these home builders, or not buying companies, buying houses directly from these home builders. And these would be new homes built, not existing homes, obviously, because, home builders, right? So that is pretty much the story as far as home builders are concerned. And the retail sales, this would be the thing that I've talked about a couple times, but they have been lower on an inflation-adjusted scale ever since March of 2021, if I had that right. Yeah, March of 2021. And they've actually been, wait a minute, do I have that right? Yeah, March of 2021, just wanted to check. And they've actually been just kind of wavy ever since that time, basically since the inflation really started to kick off in April of 2021. But on a non-inflation adjusted basis, which is what I'm showing in this left chart here, they have only started to drop in the last month. So they went down by about 1.2%, which is not a whole lot. Conceivably, just based on this prior data, you could see this series start to pick pick up again in in the coming months, July, August, September, but it's unknown exactly what direction this will go, obviously, because nobody can tell the future. But the other thing that I wanted to point out about these charts is that even on an inflation adjusted basis, you can really see the extent and the effect of that stimulus that was done by both the U.S. Treasury Department in the form of its stimulus checks and the Federal Reserve in the form of the operations that financed a lot of those stimulus checks. Okay, when they added new money to the system, essentially, you can really see the effect of that in these inflation-adjusted retail sales numbers, because if there hadn't been any new money or any dramatic stimulus involved, you could basically imagine that this line would have stayed on a steady trend after this big drop in April and May of 2020. But we really saw this thing just pick up incredibly. And so this is a really good visualization of where this inflation is coming from in the first place, because we have a global drop in supply and a global, a lot of holes essentially got blown in the supply chain. And in the case of Shanghai and Shenzhen and Guangzhou in China, we have a situation where there are still some holes being cut in the supply chain because of their lockdowns. And we have the actual spending, the level of spending, even on an inflation-adjusted basis. Again, these are as if priced in 2019 dollars, these levels here. We have on an inflation-adjusted basis, the spending still really just going through the roof. I mean, adding tons and tons and tons and tons. And by the way, this axis is in millions. So if you see 500 million at millions, that would be, and it's on a monthly basis, so that would be a month of spending of $500 billion, right? So it's really interesting to look at this chart because, like I said, it illustrates the extent of the effects that stimulus money really had on the economy. It's just absolutely insane, and it kind of tells you where that a lot of this inflation that we're seeing, of course, some of it is going to be is supply due to supply constraints and stuff like that, because you've literally taken the amount of goods and services available to everybody in the economy and you've shrunk it by really an unknown amount. It's kind of hard to measure supply. It's a little bit easier to measure spending, but it's harder to measure supply. But you do have a definite surge, an undeniable surge in demand. The year of 2020 alone, you had this surge in spending that's about 10% of the level that it was before, even on an inflation-adjusted basis. So I find that pretty crazy, and definitely shows you that this is a demand-driven phenomenon and not just a supply-driven phenomenon, as the Federal Reserve board members and other types of politicians and commentators would convey. And then, like I said, this peak in the inflation-adjusted retail numbers was reached in March of 2021. So we have been sort of not exactly on a decline, because you've seen that there have been some up months in there as well. But that was the last time that a peak was reached on a real basis in these numbers. And that's all I have for you today. The next thing that I'm going to be coming out with tomorrow, that's Thursday, June 16th, is we're going to talk about jobless claims, and there's some information coming out, some data coming out about the housing market on housing starts, that's housing construction starts, completions, as well as permits. So a lot of good data coming out about the housing market. Usually get a lot of housing data in the second and third weeks of the month is usually when that happens. So it's an exciting time if you think that is a cool market to watch. And I'm going to go ahead and sign off. It's been a pleasure speaking to you today. Hope you'll join me for Supply and Demand Daily tomorrow, Thursday, June 16th, 2022. And I hope you have a great rest of your Wednesday. Thank you very much, and I hope to see you tomorrow. Appreciate it.